Hi, everyone. Welcome. Thank you for joining us today. Thank you for joining us on today's webinar on transfer pricing for financial transactions. My name is Mili Diaz-Colodrero. I'm based in Argentina, where I've been part of the Exactera team for more than 5 years now, almost 6. Currently, I lead the team of 60 professionals and oversee a portfolio of more than 450 accounts across various regions and industries. Some things about my background. I have a BS in economics and a master's in corporate finance, and I bring more than 12 years of experience in transfer pricing, particularly around financial transactions in the financial services industry, global core documentation, planning, value chain analysis, audit support, and controversy. Over the past 5 years, I've been working directly with C-level executives, primarily CFOs, COOs, on high-impact transfer pricing strategies. My role has focused on aligning global operations with evolving tax regulations, while also identifying and implementing technology-driven solutions to streamline compliance and improve transparency. For those of you who are not acquainted with our company, allow me to start with a brief introduction. So Exactera is a global leader in tax solutions. It serves more than 500 customers worldwide, supporting companies with a suite of intelligent tax solutions, all designed to simplify compliance and improve accuracy and efficiency. Our flagship products are definitely Exactera transfer pricing, tax provision, and R&D tax credit services. We also offer ExactMatch, an AI-driven search tool that accelerates and improves benchmarking by identifying the most relevant comparables in seconds. We also have the first iteration of the Exact Report already available, Exactera's newest AI-powered assistant for transfer pricing documentation. Additionally, Exactera owns and manages RoyaltyStat database, one of the industry's most trusted sources for royalty rates and licensing data. Our team of over 100 experienced tax professionals is strategically located across key markets, enabling us to support clients wherever they operate and deliver tailored regional specific solutions. Before we dive in, let's give you a quick roadmap for today's session so that you know how we'll move through this topic. We'll start by setting the scene and talking about financial transactions, what they are, why they are important, and why also they have become such a focus area in transfer pricing. We'll look at how the regulatory landscape has evolved, including OECD Chapter 10, and how jurisdictions are applying those principles in practice. We'll walk through recent case developments and audit trends that are shaping how the tax authorities around the world are approaching intragroup financing. After that, we'll shift into lessons from the field. We'll share some practical examples and common pitfalls we are seeing when working with our clients. And finally, we'll close with some best practices and planning considerations, followed by some time for questions and discussions. Alongside the agenda, these are the learning objectives that we want you to walk away with from today's session. We'll focus on helping you better understand the key types of intercompany financial transactions and the practical challenges that they create from a TP perspective. We'll also explore how the regulatory landscape and global guidance continue to evolve and what that means from a risk and from a documentation standpoint. I think a big part of today's discussion will draw from real-world case developments and client experiences to highlight where organizations are encountering challenges. We'll also cover common risk areas in intragroup financing, and most importantly, share some practical best practices you can apply when evaluating and supporting your own arrangements. These objectives support today's CPE requirements, and you'll see them reinforced through our case discussions, our polling questions, and also examples throughout the session. We definitely covered the basics. Let's dive into a quick refresher. So what exactly counts as financial transactions? In a TP context, financial transactions refer to intercompany dealings that involve the provision, the use, or the transfer of funds between related companies. These aren't typical operational transactions. These are arrangements that impact the capital structure of the business, and because of that, they fall under the arm's length principle, just like any other control transaction. There are several key types of financial transactions that come up frequently. I think when we speak about FTs, most of us think of loans or even cash pooling arrangements, which tend to be the most common ones, right? But there's also other structures that come up frequently, such as financial guarantees that can be explicit or implicit and typically improve the credit profile of the borrower. Captive insurance. In this case, a related entity provides risk coverage to other members of the group. And this structure raises questions about risk assumption and pricing, and whether the captive is acting at arm's length. And hedging as well, which involves intercompany derivatives used for managing financial risks, right? Like interest rates risks, or even FX, currency risks as well. The complexity with hedging lies in pricing those instruments and allocating the risk appropriately. Even though some of these or all of them may seem routine, when they occur between related parties, they carry significant exposure from a transfer pricing perspective if they are not addressed properly. Why are they relevant for multinational enterprises? Well, financial transactions play a pivotal role for M&Es. They're much more than just internal fund transfers. These transactions can influence key aspects of the business, such as profitability or liquidity and tax positions, making them essential tools for managing growth, working capital, and operational efficiency. They also help reduce financing costs and currency risks, while enabling centralized oversight of financial risks. However, because financial transactions can be used for profit shifting, they have attracted increasing regulatory scrutiny. This means companies must carefully balance the operational objectives with compliance requirements. Some of the examples that we can give you around why or how FTs are critical to M&Es. Financial transactions enable companies to allocate capital where it's needed the most, right? Supporting expansion or new investments. By optimizing your intercompany funding or even cash pooling arrangements, companies ensure that day-to-day operations have sufficient cash flow and working capital without running into unnecessary borrowing costs. FTs also help maintain the right balance of debt and equity within the group, ensuring that capital is deployed in the most efficient way to maximize returns. Also, centralized management of borrowing helps reduce interest expenses and even exposure, right, to foreign exchange fluctuations, which can have, for many M&Es, a significant impact on profitability. By coordinating and aligning funding strategies, companies can also avoid redundancies of funding gaps, supporting smoother operational performance. Group-wide oversight through guarantees, captive insurance, and hedging allows for better risk mitigation and regulatory compliance. So, to summarize this section, historically, FTs or financial transactions, I apologize, I typically refer to them as FTs, have been a bit of a blind spot for taxpayers and for tax administrations as well. They're incredibly effective vehicles for shifting profits, right? You can move deductible interest payments or guarantee fees into one country while avoiding taxation in another. And that's exactly why OECD BEPS, especially through actions 4, actions 8, 9, and 10, zeroed in on them. From a profit allocation standpoint, these transactions hit both sides of the P&L. They increase expenses for the borrower and generate income for the lender. If those roles are in different jurisdictions, this is a quick, simple way to move profits, but also a quick way to get the tax authorities' attention. Then we have the whole substance over form issue, which we'll dig deeper into it later. Just calling something a loan doesn't make it a loan. If there's no realistic repayment ability or no intent to repay, it might be recharacterized or even disregarded. Same with the guarantees. Before 2020, the rules were patchy. Different countries took different approaches. Documentation was often weak. There are exceptions, right? But it was often weak. And then with Chapter 10, that gap was closed. And the OECD gave everyone a more consistent framework. Now, we're going to spend some time looking through this evolvement in landscape because this is really what is positioning in the current situation we are nowadays with regards to financing, intercompany financing. So let's take a look at the landscape. Before we talk and review Chapter 10 and how jurisdictions are adapting Chapter 10, I think it's helpful to step back and look at the landscape before. As we said previously, the regulations were patchy at best. Not for transfer pricing, right? Transfer pricing rules have existed for decades. The US has had Section 482 since the 1920s. Germany, Australia, many other countries developed TP frameworks in the following decades. So the arm's length principle itself wasn't new. The challenge was that financial transactions were largely treated as an afterthought. While the arm's length principle technically applied to intercompany loans and guarantees, the OECD guidelines provided very little practical direction. There were no examples around financial transactions. There was no dedicated chapter. That lack of guidance carried over into domestic rules. Many jurisdictions relied primarily on anti-avoidance measures, on thin cap rules, which focused on limiting debt levels, but did not provide direction on pricing or whether the transactions should exist in the first place. As a result, taxpayers faced significant uncertainty. Companies had to make judgment calls on issues like the credit rating or implicit support, cash pooling structures, often without a lot of guidance. At the same time, tax authority approaches were inconsistent, and documentation typically focused heavily on the benchmark, on pricing, rather than the broader commercial analysis. This created a fragmented environment that allowed flexibility, but also created significant exposure. Chapter 10 was introduced to close this gap by providing comprehensive and robust guidance on how to apply the arm's length principle to financial transactions. And as we'll see next, jurisdictions around the globe have moved quickly to adapt and enforce these principles. Okay, so as we probably all know, Chapter 10 of the OECD guidelines was released in February of 2020, and it's widely considered a turning point in the treatment of financial transactions. It changed the landscape by being the first dedicated guidance focused entirely on FTs. It covers key areas such as intragroup loans, financial guarantees, cash pooling arrangements. It explores the pricing of risk-free versus risk-adjusted returns, all of which had been gray areas for years. Chapter 10 was also a novel emphasis for concepts like accurate delineation and substance over form, concepts we will mention several times across our presentation today. Although these concepts are not new and were not new to transfer pricing, in fact, they have been part of the OECD guidelines for years, Chapter 10 did bring a new level of focus and specificity to how they apply in the context of intercompany financing. It also reflects broader BEPS principles, as we mentioned before, actions 4, actions 8 to 10, which aim to prevent base erosion. And so it signaled a move from a form-based compliance to a more economically grounded type of analysis, and it raised the bar significantly for taxpayers around documentation, pricing, and the defense of financing arrangements. So let's begin by grounding ourselves in the foundational concept of accurate delineation. Again, not a new term, but its application introduces several important shifts. Chapter 10 starts by stating clearly, before we even think about pricing a financial transaction, we must determine whether it actually is said transaction in substance and not just in form. This means we have to assess the economic reality. If the transaction is just a way to shift funds within the group with no expectation of repayment, or if the borrower is clearly unable to repay, we can't treat it as a loan, even if legal agreement exists. And this is very controversial and dangerous. In such cases, the OECD gives tax administrations a powerful tool. They can recharacterize a transaction, or even worse, they can disregard the transaction entirely. So to avoid this outcome, M&Es must show the arrangement has genuine commercial characteristics. And, okay, how do we get there? How do we show genuine commercial purpose? Here there are some tips to follow. We should ask ourselves some questions around, is there a legal and practical right to enforce repayment? Does the funder, the lender, behave like one, exercising due diligence, requiring protection, asking for financial covenants? Would a third-party bank make this loan under similar conditions? Is the loan used for a clear business purpose or just to plug a cash gap? And crucially, can the borrower repay? Only if these factors point to an economically real transaction do we move on to a deeper analysis on pricing. So just picture this as your entry gate. No arm's length pricing applies if the substance isn't there. What's more, an agreement does not necessarily provide substance automatically. Once we've confirmed the arrangement qualifies as set, the next step is to define it, right? Identify real commercial and financial characteristics before we do any pricing. Why? Because this is going to impact the pricing later on. Compare the contract and the conduct. Review the written terms against actual behavior. If repayments aren't made or enforced, the legal form may not reflect the two transactions. And so conduct prevails over form. Assess both parties' perspectives. And this is also very new, right? We should also be looking at the lender, not just the borrower's perspective. Is the lender performing credit analysis? Is it monitoring risk? Perform a functional and risk analysis. Identify who initiates the funding. Where's the need? Who manages the loan? And last but not least, who bears the financial risk of default? Align your financing with business and financial strategy overall. Check consistency with the group's overall funding approach. For example, if subsidiaries are usually equity funded, why are we using debt now? Do we see any deviation from the treasury policies or anything that's not aligning with the general financing? And then review transaction terms and context, right? Not just the amount or the tenor, but also the collateral and other terms, specifically around market conditions, industry norms, and the specific economic environment, right? The timing is very critical here. Once these elements are clear and we have a good picture, we can proceed then to benchmark the arm's length price. The final step is applying the transfer pricing principles to determine the arm's length pricing of the transaction. I think this is typically the part where many practitioners feel most comfortable with selecting the method, performing a benchmarking. And while these principles are probably very familiar, Chapter 10 adds important clarification around how they should be applied. One key message is that pricing is not just about finding comparables. It's about understanding what actually drives value and risk in the transaction. A major starting point is the borrower's credit rating profile. The OECD places significant emphasis on accurately delineating the transaction and evaluating whether the borrower has the capacity to repay on a standalone basis. And this is a critical concept because it leads to the distinction between the issuer rating and the issuance rating. Generally speaking, transfer pricing analysis focuses on the borrower's standalone creditworthiness, unless there's clear evidence that group support would influence third-party pricing. Loan terms are also critical drivers. Factors like tenor, currency, seniority, collaterals, all of these affect the risk level. In some cases, these terms also help determine whether a transaction truly behaves like that, or whether it might have characteristics of equity. Chapter 10 highlights the importance of the economic context, including the timing, the geography, and industry conditions, all of which can materially affect pricing outcomes and must therefore be considered. When it comes to method, Chapter 10 reinforces that we must choose the most appropriate method based on the specific facts and data available at the time of the analysis. The CAP method is often the preferred one when reliable market data exists and is commonly used specifically for loan benchmarking. There are others. The yield approach focuses on the lender's expected return, can be particularly useful in more complex lending arrangements or even when no sufficient good comps are available. The cost of funds approach looks at the lender's funding costs plus an arm's length margin, which is often relevant in treasury structures. And then also the credit default swap spreads that can also help assess market-based credit risk, although this one's generally used as supporting evidence rather than a primary method in practice. Even after selecting the method, comparability adjustments are often necessary. Chapter 10 specifically highlights adjustments related to implicit support, currency, geographic differences, and broader economic conditions such as timing or collaterals. Now, let's shift our focus a little bit from theory to reality. How jurisdictions are actually adopting Chapter 10. This is where OECD guidance becomes real, right? Like real audits, real documentation requirements, real exposure. This table highlights 3 important things for each country, and it's content heavy, but I think, bear with me, I think it's very useful to go through this. The US hasn't formally rewritten regulations around Chapter 10, right? Section 482 still governs, but it has clearly signaled its position, especially through a 2023 advice memo focused on implicit support. Key takeaway here is that the IRS expects group affiliation to influence borrower creditworthiness where it would matter to a third party. That means high interest inbound loans into the US are increasingly scrutinized. We're also keeping an eye into the Eaton case, which could set important precedent around guarantees and implicit support. The UK. The UK has been extremely active. In fact, the HMRC updated its guidance and released new compliance guidelines in 2024 that strongly reflect Chapter 10 principles. Their focus is substance over form and analyzing transactions from both the lender and the borrower perspectives. Enforcement has also increased significantly. Large multinationals now face enhanced documentation expectations. Germany represents one of the most aggressive legislative adoptions, if you will. New stat rules introduced formal debt capacity testing and generally start pricing from a group credit rating unless taxpayers justify a standalone approach. The burden of proof is now clearly shifted to taxpayers. German administrators have also clarified that outstanding loans must now have supporting debt capacity documentation, which significantly raises compliance expectations. This is not specific about financial transactions, but it's definitely interesting considering that anything that happened before this change in 2024 could be also under the radar. Australia already had a strong guidance, but I think the Singtel decision has reinforced enforcement, right? We'll dig deeper into the case later on when we review some actual world law cases. But authorities evaluate commercial rationale and borrower capacity above forms. And it reinforces that high interest deductions must be economically supportable. Denmark stands out for its strict procedural requirements, right? Transfer pricing documentation must be filled within 60 days of the tax return deadline, and there are meaningful penalties for non-compliance. We know this by experience. The burden is firmly on taxpayers as well to proactively demonstrate arm's length outcomes. Netherlands has expanded guidance to explicitly address financing instruments. Dutch authorities strongly favor the GAP method and place significant emphasis on consistency across financing arrangements. They're increasingly cross-checking intercompany terms against any existent third-party debt, which means internal financing needs to align with external funding realities. So when you step back, the common themes across jurisdictions are very consistent. Debt capacity, substance over form, accurate delineation, commercial rationale, and behavior. What's also changed is enforcement. Financial transactions are no longer secondary review. They are active audit priorities globally. The key question for us, or taxpayers today, is where these rules apply and whether they are addressing them proactively or waiting until an audit forces the discussion around their financing structures. We're going to look at a few case studies that illustrate how Chapter 10 and landscape across an evolution across different jurisdictions is actually reshaping the global transfer pricing landscape for FTs. This is, I think, a good opportunity to connect the dots, right, between the theory and the real world cases and actual enforcement. What we are seeing globally is a clear move from simply looking at the numbers, what the interest rate is, to really examining the underlying economic substance of the transaction. Tax authorities aren't just interested in the paper anymore. They want to see that the debt is real, that it could realistically be repaid, and that both lender and borrower are acting in commercially rational ways. Functional roles, actual behavior behind the transaction are now front and center. Even if you have a perfectly benchmarked interest rates, If the narrative doesn't make sense, tax authorities are willing to recharacterize the transaction or disallow the interest. So in the next few slides, we'll walk through some examples where these principles have been applied, showing how not only tax authorities, but also courts are really testing these items. I think this will help bring this concept to life. The first one, Nutreco España. This case illustrates how domestic anti-avoidance rules are applied in practice to challenge cross-border financial arrangements. Nutreco Spain had taken on substantial intragroup debts, more than 300 million euros, to help finance an acquisition. Although Spain wasn't the acquirer, it served as a conduit and deducted over 30 million euros in interest. The Spanish tax authority challenged the deductions under the anti-avoidance rule, not only transfer pricing grounds, but on the basis that the financial structure was artificial and designed slowly to obtain a tax advantage. The case, obviously made its way to the Supreme Court, which ultimately sided with the tax authority. The court ruled the transaction lacked real economic or legal substance beyond this tax advantage, and simply having a cross-border element or a formal legal structure wasn't enough. This ruling reinforces some important themes. First, the need for real economic substance in intragroup financing. Entities can't simply act as funding channels or conduits for group-level strategies without assuming meaningful functions or risks. Again, risks and functions. Second, it aligns with international guidance, including OECD principles through Chapter 10, that focus on the purpose and economic effects of financial transactions. This is a strong reminder that formal loan agreements must be backed by genuine commercial rationale. Okay, this one is very well known, Singtel case in Australia. This one is a strong example of how courts and tax authorities approach intercompany financing. At the heart of it, Singtel Australia issued a $5 billion loan to a related entity in Singapore with an interest rate of more than 30%. Of course, the ATO challenged the arrangement, arguing that the terms were at arm's length, especially given the borrower's limited debt capacity and the lack of any group support. As a result, they disallowed $900 million in interest deductions. The courts ultimately sided with the ATO. The High Court locked in the ATO's position and highlighted, from a TP perspective, formal agreements, even if properly executed, won't stand up if the economic reality doesn't support them. Substance over form. The courts looked at function, substance, financial capacity, and commercial logic. This aligns closely with the OECD Chapter 10. It reinforces the need to delineate, consider both perspectives, ensure pricing reflects what truly independent parties would agree to. That's one key question we always have to ask ourselves. It's a clear message, right? And I think this is the last one, but also very well known in the industry. Back in 2009, BlackRock acquired Barclays for $13.5 billion. A portion of this deal, around $7 billion, was funded through intragroup loans, for which the company in the UK claimed, obviously, interest deductions for. The HMRC challenged the deductions on two fronts. First, under transfer pricing rules, they argued no independent party would have made the loans on those terms. Second, under the UK's unallowable purpose rule, they said the primary purpose of the loan was to secure a tax advantage, not a proper business benefit. the final judgment for this case was mixed, right? There was one for the transfer pricing argument and another one for the unallowable purpose rule. But essentially, the court found and agreed with the HMRC that tax advantage was a key driver behind all of this very complex structure they built. From a TP Chapter 10 perspective, this case reinforces several important points. It confirms that accurate delineation is more than just pricing, right? The underlying purpose and the economic rationale also matter. Second, it highlights the importance of evaluating the borrower's commercial perspective and whether the structure is something third parties would genuinely agree to. And finally, even if a transaction meets the arm's length test, tax authorities can still disallow deductions if the structure appears to serve no real commercial objective beyond a tax advantage. As we say, these cases really represent how the landscape has evolved with Chapter 10 and the new guidelines. To begin with, arm's length pricing is a must, but is not sufficient. I think historically, many organizations approached intercompany financing primarily through the benchmarking exercise. If you had a solid benchmarking study, you were generally in a strong defensive position. Well, what we are seeing now from both tax authorities and courts is that pricing alone is no longer enough. They are evaluating the entire commercial context of the transaction, why the financing exists, whether the borrower actually needed the funds, whether the structure makes sense from a business perspective. Debt capacity and creditworthiness are central. I think creditworthiness was typically in the scene for FTs, but not debt capacity. One of the biggest shifts we're seeing is there's a growing focus on this from all across the globe. Authorities are increasingly asking, could this entity realistically sustain this level of debt if it were operating independently? This includes evaluating standalone credit profiles, repayment ability, and realistic funding alternatives available. In some cases, we're even seeing authorities challenge the amount of intercompany debt itself. Economic substance and business purpose are driving outcomes. Another consistent theme across jurisdictions, right? Emphasis on economic substance and the commercial rationale of the transaction. Tax authorities are looking beyond contractual terms and focusing heavily on actual conduct, how funds are used, and whether the transaction delivers real value. Financing arrangements that appear primarily to designed to generate tax benefits are facing significant scrutiny. This one, I think it's very interesting, while also controversial, right? Even though a legal contract exists, that doesn't necessarily mean this will be accepted as an intercompany loan. Anti-avoidance rules are expanding the risk landscape. We're also seeing transfer pricing increasingly intersect with anti-avoidance and purpose-based rules. Even when a transaction appears to meet arm's length pricing, deductions can still be denied if it's determined that commercial justification is lacking. So this delay approach is becoming much more common. Documentation expectations are evolving, right? As a result, organizations are now expected to support not just the pricing, but also the borrower's capacity, credit analysis, commercial rationale, alignment between contractual terms and actual behavior. In many ways, the narrative and the business story behind the financing has become just as important. What's really key here is that I think from a TP perspective, this is simply happening across any type of intercompany transaction, but historically, FTAs were not really part of, and they were a distinguished type of transaction. They still are, and we could argue whether they are sometimes even looked at with more in more detail, more in depth. But I think they are now joining the rest of the intercompany transactions in terms of the narrative and how you tell the story when you're building documentation, especially. Overall, the intercompany financing is moving away from being purely a technical pricing benchmarking exercise toward a much broader commercial and economic evaluation. And so organizations that proactively address these areas are going to be significantly better positioned to manage transfer pricing risk. Okay, third poll question. In light of recent regulatory developments, how would you describe your response or your client's response so far? Proactive review and update, some updates, but not consistently. No specific steps have been taken, unsure how this applies. There's no right or wrong answer. What we are seeing, and we're going to talk about this more now in our next section, is that there's a lot of different responses happening. And yes, most of them are driven by history of audits or IDRs from tax administrations, and obviously the exposure, the level of exposure, right? The bigger the transaction, the bigger the fear, the bigger the exposure. But I still see a lot of things happening in the TP world when it comes to financing arrangements. I'll give you 10 more seconds. Okay, let's take a look. Okay, 43% proactive. That's actually amazing. And no one replied unsure how this applies. I think that's great. At least this woman is serving its purpose. Okay, now into one of the last sections of today's session, lessons from the field. Common pitfalls in FT implementation. This is strictly coming from real world examples, evidence, and working with more than 400 clients over the past 5 years, identifying and helping them support their FTs across multiple industries and regions. The first one, probably the most common mistake we see. Companies spend significant effort getting the interest rate right, running benchmarks, pulling comps, documenting spreads, and that's it. But as we saw in the cases earlier, tax authorities have moved well beyond pricing. They want to know other things. Could the borrower realistically take on this debt? Are the repayment terms? What are the repayment terms? Is there actual intent and ability to repay? If we can't address these questions convincingly, then the interest rate becomes irrelevant. What's really interesting is that, as I say this, I can think of a lot of clients, a lot of cases where we see clients are only looking into the pricing. Second pitfall, this one's a big one. If you have any third-party debt, whatever that is, bond issuance, a third-party bank loan, tax authorities will compare those terms to your intercompany arrangements, right? And so consistency matters. If you haven't considered your external debt when setting intercompany terms, you are creating an easy target for auditors. It might seem obvious, again, but clients almost never disclose and or provide background on their third-party financing firsthand. It is the consultant, it is us, who typically reach out and ask for this. And sometimes we have to even argue, why do you need this information? Whether there's a good reason why, right? You want to keep that in mind when you're documenting financing arrangements. Next one, applying global policies. So we see this frequently with global groups that want efficiency, right? They develop a group-wide financing policy, standard rates for every single jurisdiction. The intention is great, actually, right? Consistency, ease of administration. But the execution often ignores there's local realities that need to be considered. Different countries have different rules, right? Different documentation requirements, different views on what constitutes arm's length, different think up rules. So credit rating alone doesn't capture all of this. You need to layer in local debt capacity, local regs, and the specific purpose of the financing in each jurisdiction, which might be different. In short, one size does not fit all. This fourth one catches a lot of people off guard, right? You set up a loan many years ago. The rate was arm's length at the time. You have strong documentation, and then you move on. Markets change, interest rates fluctuate, and tax authorities are now asking, if rates dropped, why didn't the borrower refinance, right? This one I mentioned before, very controversial indeed. If there's a legal agreement, right, your financial arrangement could be overruled. This is particularly relevant for medium or long-term loans, right? The lesson is that financial transactions require monitoring, not just an upfront analysis. Assuming any rate is defensible. Some clients come to us believing any rate can be supported if there's a robust enough analysis and enough good comps. And this is just, unfortunately, not true. High interest rates attract attention. When a tax authority sees a double-digit rate, they're going to dig deep. And they won't just look at the benchmarking. They'll ask questions, right, about the purpose, the actual use of funds, the borrower's financial situation. So documentation helps, but it won't save a transaction that lacks genuine substance. And the last one, cash pooling. This is a very complex area. And the mistake we see most often is treating it as a standalone arrangement. Companies analyze the cash pool in isolation because it's pretty complex, right? The header, participants, there's interest allocation, draws, withdraws, without considering how this structure per se fits into the group's broader financing picture. But if you have intercompany loans alongside the cash pool, or even third-party loans, all of these interact, right? The debt capacity of a participant in the pool is affected by other obligations, and so the rates need to be coherent across instruments. Tax authorities, they see the full picture, and when things don't add up, they will ask questions. I think here with the pitfalls, we're gonna jump into best practices now, is where I would definitely make a screenshot and make sure that, we're checking all the boxes here. So what's the common thread? What ties all of this together? Each of these pitfalls reflect the same underlying gap, treating financial transactions as isolated pricing exercises rather than part of an integrated strategy. Tax authorities today, we see, are sophisticated. They are not just checking whether your interest rate falls within the range. They're looking at the whole picture, and that's making, things more complex for financing structures. The companies that we see are best positioned are those that approach financial transactions strategically. Clear policy framework, strong documentation, ongoing governance and monitoring. Those that treat it as a box-ticking exercise are the ones that end up in situations like, we discussed in the case studies, adjustments and even disallowable interest. The bottom line is that pricing is necessary, but is not sufficient. Substance, commercial rationale, and strategic integration are important. So, based on all of this we're seeing, right, the audits, case laws, real world experience with clients, here are a few practical areas organizations could focus on. First, delineate your transactions, understanding who's doing what, who's making decisions, who controls the risks, whether financing reflects actual business conduct or behavior. Functions. Authorities are increasingly evaluating whether lending entities have real treasury capability and whether the borrowers actually have the financial capacity to take on the debt. Robust pricing. This is already considered, but don't forget about it, right? Benchmarking remains important. It needs to be supported by strong credit rating analysis, reliable comparables, and appropriate adjustments most of the time. Alignment with business purpose. Financing arrangements should clearly support the commercial objective. They will ask questions around what's the goal and whether we are fulfilling the goal by taking on this debt. Strong intercompany agreements. 10, 15 years ago, I would have said probably, intercompany agreements are optional for the most part. Well, now I suggest my clients to put together intercompany agreements that are clear, enforceable, and consistent with the actual reality and behavior. And monitoring, right? This area, FTs from the TV perspective, is evolving quickly, staying current with local rules, with any new updates, with audit trends, even with case laws, right? Ultimately, the organizations that succeed are the ones that are treating intercompany financing as an integrated, comprehensive strategic function. So here we have some few takeaways. I think we've been through all of these. There's not a lot of time left, and I would like to have a couple of minutes at least for questions. So you can just go through. I think we have mentioned all of these over and over again. I want to thank you for your attention. Let me take a look at the questions and see if there's anything we would like to share. Okay, so someone's asking, how often should we reassess intercompany financing terms? There's no such thing as a fixed requirement, not even under the OECD or local guidance. In practice, I would say companies should reassess whenever there's material change in the facts or the circumstances, right? Changes to the business, changes to the borrower credit profile, market interest rates fluctuations, even the group financing structure, right? Or economic conditions in the industry. There are so many examples from the past 5 years that we could mention, COVID included, right? So from a practical perspective, my take on this will be just monitor the rates on an ongoing basis, like quarterly, biannually, annually, whatever works for the company, even if the legal terms of the loan remain unchanged. This will help ensure continued arm's length support. So practical first steps when you want to implement requirements across existing financing arrangements. There are a lot of these happening with big multinational enterprises. I would say, let's start with performing a risk-based analysis of existing intercompany financing, right? Let's do a gap analysis. This includes evaluating the borrower debt capacity, something that is typically ignored, reviewing credit rating methodologies, confirming alignment between third-party and internal financing, and assessing consistency, right, across financing instruments within the group. I think that's where you can start. Many companies now benefit from documenting treasury functions and decision-making process. I think that's something with technology and AI. You can leverage tools through which these tasks can be accelerated and the efficiency can be maximized, so that it's not such a burden for corporations. Time to close up so we can wrap up the session today. Again, thanks everyone for your attention. It's been great to have you joining us. Thank you very much and have a lovely rest of the day.